To understand the significance of Silicon Valley Bank's collapse, we first need to know exactly what this bank was and why it mattered so much. Silicon Valley Bank was founded in 1983 in California, and it quickly became one of the most important financial institutions in the world of tech and innovation. Unlike traditional banks that serve a broad range of customers, SVB specialized in providing banking services to startups, venture capitalists, and tech companies. It was the go-to bank for early-stage companies in Silicon Valley and beyond, offering loans, funding, and financial services tailored to the unique needs of high-growth businesses. SVB had built a reputation for understanding the fast-paced world of technology and innovation. In fact, it was deeply embedded in the startup ecosystem, with its clients including some of the most well-known names in tech. Companies like Roku, Pinterest, and Etsy relied on SVB for their banking needs. For many startups, having a bank like SVB wasn't just about managing money, it was about having a partner that understood their needs and could help them grow. But this specialized focus on startups and venture capital meant that SVB was heavily exposed to the risks of the tech sector. And as we'll see, these risks eventually caught up with them. Chapter 2: The Collapse of Silicon Valley Bank. So, how did Silicon Valley Bank collapse so suddenly? Let's break it down. Exposure to interest rate risks. One of the key factors that led to SVB's collapse was its exposure to interest rate risk. As the Federal Reserve started raising interest rates in 2022 and 2023 to combat inflation, SVB's bond holdings took a major hit. In simple terms, when interest rates rise, the value of existing bonds falls, and SVB had invested heavily in long-term treasury bonds. As the tech sector started to feel the pressure of rising rates, venture capital funding slowed, and the startups SVB served began drawing down their deposits. This put pressure on the bank's liquidity, its ability to meet the demand for withdrawals. In a desperate attempt to shore up its financial position, SVB sold a large portion of its bonds at a loss. But this move triggered a wave of panic. A bank run. The bond sale was a red flag, and it quickly led to a classic bank run. Venture capital firms and tech companies began withdrawing their funds in large amounts, fearing that SVB was in trouble. Within a matter of days, the bank couldn't meet its obligations. This caused a chain reaction of fear and uncertainty, leading to the FDIC stepping in and shutting the bank down on March 10, 2023. In just 48 hours, a major bank that had been around for nearly 4 decades collapsed, and a significant portion of its clients, many of them early-stage startups, were left scrambling. Government intervention. In the aftermath of SVB's collapse, the U.S. government stepped in to ensure that all deposits, insured and uninsured, were protected. This was an essential move to prevent panic from spreading to other banks. The Federal Reserve also announced emergency measures, including a new lending facility for banks facing liquidity problems, to stabilize the financial system. Chapter 3: Immediate impacts on the tech industry and startups. SVB's collapse hit the tech and startup world particularly hard. For years, SVB had been the financial backbone for many early-stage companies. With its sudden failure, the immediate impacts were felt across the sector. Access to capital. One of the biggest problems for startups was the sudden loss of access to capital. Many startups had large portions of their cash reserves with SVB, and without access to those funds, they were unable to pay employees, fund operations, or make critical investments. This created a ripple effect that affected not just the companies directly connected to SVB, but the broader ecosystem as well. Investors, banks, and venture firms became more cautious, tightening the flow of capital to riskier startups. Payroll issues and layoffs. As cash reserves dried up, many tech companies found themselves unable to meet payroll. This led to mass layoffs as companies scrambled to stay afloat. While the government stepped in to guarantee deposits, the damage was already done in terms of job losses and disruption in the sector. Investor sentiment. SVB's collapse also caused a shakeup in investor sentiment. Venture capitalists and angel investors became more cautious, with many rethinking how they allocate funds to startups. The collapse of SVB further highlighted the risks involved in the venture capital industry, especially when it comes to managing cash reserves and liquidity. Chapter 4: Broader implications for the banking sector. SVB's collapse has broader implications for the banking sector, especially when it comes to smaller regional banks. If a bank that catered to some of the wealthiest and most innovative clients in the world could fail so quickly, it raised concerns about the stability of other banks with similar exposure. Banking confidence and stability. While the government moved quickly to contain the fallout, SVB's failure raised important questions about the stability of the banking system. While major banks like JP Morgan Chase and Bank of America are seen as too big to fail, smaller banks that focus on niche sectors or regional markets may be more vulnerable. Investors and depositors became more cautious, wondering which bank might be next. Regulatory reforms. In the wake of SVB's collapse, there is likely to be a push for increased regulatory oversight of smaller banks, especially those that hold large amounts of illiquid assets like long-term bonds. Expect to see more scrutiny on risk management practices and more stringent requirements for liquidity and capital reserves. Policymakers are likely to introduce reforms to ensure that banks are better prepared for future interest rate hikes and market shocks. Impact on the lending market. As smaller banks and regional lenders become more cautious in the wake of SVB's collapse, the availability of credit could tighten. This would affect not only startups and tech companies but also individuals seeking mortgages, auto loans, and other types of financing. Higher borrowing costs and stricter lending standards could slow down economic growth in various sectors, including real estate and consumer spending. Chapter 5. Global Economic Implications. While the collapse of Silicon Valley Bank began as a US-centric event, its effects quickly rippled out across the globe. After all, the bank had international clients and was deeply embedded in the global tech ecosystem. Disruption to global supply chains. Many of the startups and tech companies affected by SVB's collapse play an integral role in global supply chains, particularly in industries like semiconductors, software development, and renewable energy. A slowdown in these industries could have far-reaching effects on global supply chains, particularly in countries that rely on technology imports or tech-driven exports. Impact on global venture capital. SVB's collapse will also likely have an impact on global venture capital flows. Silicon Valley has long been the epicenter of the world's venture capital industry, and the failure of such a prominent institution could make investors more cautious. As capital becomes more scarce and harder to obtain, startups across the globe may find it harder to secure funding, leading to slower innovation and economic growth. Potential contagion in other economies. While the U.S. government's intervention helped contain the immediate fallout, the collapse of SVB could lead to financial contagion in other economies. Countries that have close economic ties to the U.S. or depend on technology exports from U.S.-based companies could feel the effects of a slowdown in tech funding or disruptions in supply chains. The collapse could also dampen investor confidence globally, leading to lower stock prices, especially in the tech sector. Chapter 6. What's next? The path forward for Silicon Valley Bank's clients. So, what's next for the companies and startups that were impacted by SVB's collapse? While the situation is far from ideal, there are steps that businesses can take to mitigate the damage and move forward. Securing new banking relationships. One of the first things affected companies need to do is secure new banking relationships. Many of them will be looking for alternative banking partners that can offer similar services to what SVB provided. However, they'll also need to be more strategic about managing liquidity to avoid similar problems in the future. Diversifying funding sources. Startups and venture firms will likely begin to diversify their funding sources. This means looking beyond traditional banking relationships to include alternative lenders, private equity, and international capital. By diversifying their financial partners, companies can reduce their dependence on any single institution. Government support and policy changes. In the long term, expect to see more government support for startups and tech companies, as policymakers recognize the critical role they play in the economy. Additionally, new regulations and reforms in the banking sector are likely to help create a more resilient financial system moving forward. The collapse of Silicon Valley Bank is a wake-up call for the financial system, tech industry, and global economy. While its effects have been far-reaching, it's important to remember that the system has shown resilience, and with the right regulatory changes, we can avoid similar crises in the future. For startups, investors, and policymakers alike, the lessons of SVB's collapse are clear. Diversification, risk management, and liquidity are essential to navigating a complex and fast-moving global economy. Thanks for tuning in to this deep dive into what the collapse of Silicon Valley Bank means for the global economy. If you found this discussion helpful, don't forget to like, share, and subscribe for more insights into the world of finance, banking, and global markets.